Hey, it's Tom here and welcome back to the channel. So throughout my YouTube feed this week, I've seen a massive number of videos about the stock market is about to crash or the stock market is crashing. So I thought it would be a good time to take a look at something like the S&P 500 index and just see how big stocks are down. Are we down 5, 10, 20, 30%? What's going on? And when I looked at that index, I found that we were down a massive 1.5% from all-time highs. It's crazy how quickly people can become fearful, even with fairly small movements in stock markets. Now, that doesn't necessarily mean there's not a crash coming or whatever. That's not something me nor anyone else really has the ability to predict. But in this video, I want to share some thoughts on kind of a hypothetical scenario of if the stock market was to crash, and to actually share some of the pretty straightforward maths behind why a stock market crash is actually quite a positive thing for a long-term net buyer of stocks. If you're someone that's going to be investing for 10, 20, 30, 40 years, you're actually going to be quite a bit better off in terms of where you end up at the end of your investment journey if you have very frequent stock market crashes and you're able to continue buying throughout that entire time period. So I want to jump straight into that, basically just share this hypothetical scenario for you. And there's a lot of quotes out there along these same lines that often say something like, previous stock market crashes always look like an opportunity, and future stock market crashes, for whatever reason, are always perceived as a risk. And I think I saw a tweet along those lines yesterday as well, which I'll try and track down and put up on the screen here so you can see that as well. But without further ado, let's get straight into some of these market crash scenarios, just so I can talk you through some of the potential benefits for you as a long-term net buyer of stock market investments. Okay, so for demonstration purposes for this video, basically what I've done is I've made up a hypothetical index that I've called the Investing with Tom Index. I'm sorry, this is not currently available for investment, but it's going to be hopefully a useful demonstration to kind of show you some examples here. So in this Investing with Tom Index, we have basically three different scenarios. So the first scenario, which is the blue line on this chart here, is basically that the index just steadily goes up every single year, compounding at about 8%. So 8% a year, it continues to compound, and the index kind of is steadily curving upwards, which is very nice, obviously. So that's the first example. The second scenario there in the orange is slightly different. So in this case, the Investing with Tom Index goes up about 15% a year rather than 8% a year for a handful of years. And then for whatever reason, whether it's market valuations getting kind of stretched or whether it's interest rates starting to go up, whatever the driver might be, the returns from that index after a few years actually slow right down to only 3.5%. And after a 10-year period, we basically end up at the exact same endpoint as the just regular slow and steady compounding at 8% scenario ends up. And finally, we have this third scenario in grey, which represents about an 8% return, again, for a handful of years. We then have a big 50% drop, so we're sort of simulating a stock market crash with this Investing with Tom Index. And then for the remainder of that time period, it actually grows at a really fast rate. So it grows at about 26% per year. And then after 10 years, again, lines up exactly with these other two scenarios. So with these three scenarios, you have one that kind of trucks along steadily, one that does really well and then slows down a bit, and then you have one that crashes and then recovers quite quickly. And all three of these scenarios end up at the exact same endpoint after a 1-decade period of investment. Now, my question to you basically is, if you had to invest over the next 10 years, which of these three scenarios would you prefer to be investing through? Would you be someone that prefers to just have the steady 8% per year? Are you someone that would actually quite like some quick gains in order to get maybe to some sort of absolute portfolio value number quite soon, and then you're happy to have kind of lower returns afterwards? Or are you someone that likes a little bit of pain like myself and is comfortable with having that big 50% drawdown and eventually ending up in the same spot after that 10-year period? Well, if you ask just any random person off the street, I think you'd actually be somewhat surprised by the answers. I feel as though a lot of the people watching this video probably know which of these portfolios would work best as long as you're contributing to it consistently. But a lot of people really don't like volatility. They like to get a steady 8% per year or 10% per year from markets. And this is really the attraction to not investing in the stock market for a lot of people. oftentimes investors really prefer to maybe get 4 or 5% in some more steady investment than, stomach the volatility and maybe get 8 or 10% per year. But for me personally, I would much prefer to have the stock market crash from time to time. And I want to basically walk you through some of the basic maths behind my reasoning there. Now, the basic reasoning for my choice there in terms of preferring the stock market crash is basically because if you were to invest, let's say, $10,000 per year every single year through all three of those different scenarios, the one in which you would end up with the most money at the end is actually the one with the market crash in it. And I will put up a chart here to show you some of those values so that you can kind of see the difference between each of those three scenarios. So in the steady 8% a year scenario, you end up with a portfolio value of about $166,000. In the one that kind of races ahead and then slows down eventually, you get about $149,000. And then in the situation with the market crash, you end up with closer to $208,000. And of course, as you can see through some of the middle years of that chart, the one with the stock market crash actually lags for a period of time. Obviously, you have that big drawdown in year 5 or 6, and you have to stomach a lot more volatility in order to end up with that larger number at the end. But nonetheless, if your goal purely is to have the most money at the end of the investment period, the best option to go for is the market crash situation. So why is that the case? Every time we look at financial media, or a lot of YouTube channels are guilty of this, we often see stock market crashes perceived as a really bad event. That's something that investors ideally want to avoid. But really, when we look at it and look at some of the details, if you're able to continue investing consistently, stock market crashes are actually quite good. And the basic reason is because when market prices are depressed and you're continuing to purchase into the stock market, you're able to buy more ownership in the underlying businesses in the stock market than you would have been able to if prices remained high. So let me just put up another chart here kind of demonstrating that. This is basically how many sort of shares you'd be able to purchase in this Investing with Tom index each year. And you'll notice that there is really a big spike in those middle years for the stock market crash example. So we're continuing to invest our hypothetical $10,000 throughout this scenario. And you'll see that in the year 2026, and this one that I've kind of just made up the index for, when the market crashes, and even in the years following as it continues to recover, so from 2026 to 2029 or even right through to 2030 really, the scenario in which you're able to buy the most shares and get the best sort of value for money is in the situation where the market has crashed and prices are depressed. And over the full investment time frame, this is sort of the hypothetical number of shares you end up owning of this index. So again, slow and steady, 8% per year, you end up owning about 771 shares. Where you get the faster 15% a year, but then the flattening off down to 3.5% per year, you only get 690 shares. And in the market crash scenario, where you're able to keep buying with these depressed prices, you're able to get up to 966 shares in this hypothetical index, and that's really the core driver behind the outperformance that you see in that scenario. So that's what the maths looks like in terms of a market drop really helping your long-term performance. But I just want to spend a couple of minutes on some of the prerequisites that you really have to have in place to take maximum benefit of that. So it's easy for me to just do numbers in a spreadsheet and say, yeah, if you keep investing through that time period, you'll do very, very well. But oftentimes when those market crashes are happening, those are times when people are most fearful and really least willing to put money into stocks because they see their portfolio values going down all the time. Perhaps it can be at a time where job losses are happening and you simply don't have the cash to put into investments. So I just want to talk through kind of a few of the core things that you need to have in place to really set yourself up for success through some of these more volatile markets. Now, the first thing, and this sounds extremely obvious, just again looking at some of these basic numbers, but when you're in the moment and there's maximum fear and market prices are crashing, this can be a trap that a surprisingly high percentage of the population falls into, and that is simply selling based on fear. Now, the core reason for the good performance of the market crash scenario and the examples I just showed is because none of the shares were sold at those low prices, and in fact the opposite happened. So the buying continued to happen through that period of time. We didn't necessarily increase the amount of dollars we were putting into the market to continue buying even more than usual, but we were able to pick up more shares than usual with that same sort of nominal amount of dollars because market prices were depressed. And as Buffett might say, whether we're talking about stocks or socks, he likes to buy quality merchandise when it's marked down. So that's the first thing, is you can't sell. And there's a couple of things that you really have to have in place to be able to not sell effectively. Now, the first part of it is obviously probably more mental than anything, with being able to stomach the volatility and kind of continue investing through just general fear in the market. That's the first thing. But there are some structural things that you can set up in order to avoid selling. So obviously you really don't want to be forced to sell. So if you're borrowing money to invest in stocks and you're putting yourself at risk of things like margin calls, not a great scenario to be in. So obviously not taking on margin is something that a lot of the great investors will tell you, and that is pretty much exactly for these types of situations. You really don't ever want to be in a position where you're forced to sell stocks, particularly at the worst possible times. And if you're someone that potentially could get quite fearful through those stock market crashes, hopefully that Warren Buffett quote earlier about stocks and socks helps you a little bit. The other one that I've just read recently, so I'm actually reading a book, Richer, Wiser, Happier, at the moment by William Green, which is very good, and I will do a book summary of that at some point. But in the chapter on Howard Marks had quite a funny quote about most of the time the end of the world doesn't happen. And that's a situation where he's kind of found himself in a couple of times. The end of the financial world looks like it might be on the horizon, and he's just kind of continued to invest because, like he says, most of the time the end of the world doesn't happen, right? So that's a good little bit of motivation, hopefully a quote that can keep you investing through those time periods as well. And finally, the other thing you can do in order to not be forced to sell at the worst possible times is to run your life like Berkshire Hathaway. Now, this is a concept that I kind of first came across from Jason at the After Dinner Investor. Jason and I are actually going to be collaborating on an Alibaba podcast episode soon, so keep an eye out for that one. But Jason sort of applied this concept of what Berkshire Hathaway do at their business to what he does at his own life. So Berkshire Hathaway, for example, will never go below $20 billion in terms of the cash reserves. They need that available in terms of being able to pay out on big insurance claims that might happen, and they're really going to be the last business standing if everything goes to hell in a handbasket. So if you can do the same thing personally, have a lot of cash around personally relative to your portfolio, and even if you do have some short-term losses of income or anything along those lines, you're going to be in a position where you're really not forced to sell assets at, like I say, the worst possible prices. So that's it for me for this one. I do hope you enjoyed the video, and again, though, that kind of basic scenario on a market crash is kind of a useful example of how things can look in practice. So hope you enjoyed it. If you did, please hit like and hit subscribe, and I will see you in the next video. Cheers.